So the topic for the day is credit risk analytics, credit risk modeling. So that's a session that we will be having for the next few hours. We will be starting at, or rather, we are starting right now, and it will run till another 3.5 hours, or let's say at the max 4 hours. The session will run into, and we will have a bit of demonstrations also towards the end of the session. So the second half, let's say, or towards the last hour and a half or so, we will be displaying a demonstration also using the software with a couple of activities out there. So that's the particular agenda for the session. Now, a bit of introduction about myself. I am Akshay Dixit. I work with the SAS Institute here in India, um, being associated with SAS for almost 10 plus years here. I work with the education department of SAS and happen to be conducting mentoring sessions, training sessions across the Asia Pacific region into different areas of work, to programming, data visualization, and analytics as well. So that's about it. Now we have a lot of participants and it's very short on time. I would have ideally liked to be knowing each one of you individually, having an introduction of all of you. However, for a small session today, we'll just avoid having any kind of an introduction there. And let's get started with the particular topic. Right now, just to, because there are a lot of participants out there and there would be internet bandwidth consumption for all of them. I'll just be turning off the video so that it's convenient for all of you and you can then concentrate on the screen share as there. Rather than having any kind of disturbances in terms of the streaming of the session. All right, so let's get started here. Now, uh, the purpose of this particular session obviously is to make people attending this session aware of, firstly, the broad spectrum of area of work about the credit risk, and secondly, about the different ways SAS handles or the different options available or the tools available in SAS to be doing these kind of calculations there. Right. Now, many of you would have heard about SAS. Many of you would have probably used SAS probably or seen in SAS in some different capacities at least. But a brief background about us, first of all, to start off with, and then we get into the topic there. Now, at SAS, we are almost a 47 years old organization, or rather, let's say 47 years young organization. We've been always innovating there. We're primarily working into the area of analytics and data management and data visualization. Now, over these period of years, we have been associated with many verticals or many industries per se, whether it is the manufacturing, whether it is the pharmaceutical, that is the clinical industry, whether it is the government organizations in terms of policy making, whether it is insurance, whether it's banking, telecom, oil and gas, retail, and e-commerce and whatnot. Yeah, so pretty much every industry that happens to be there right now, we have been associated with many of those clients in terms of doing data analysis for them, or they have been choosing SAS as a preferred platform for doing data analysis. Correct. Now, the usage of SAS in the main area of interest, which is the banking industry, happens to be a very old story or a very long story rather. So one of the early adopters of analytics was the banking industry, and for a very obvious reason, because it's one of those B2C industries or a business to consumer industries where there's a lot of data points that are getting generated because of the transactions that are happening there. Correct. Irrespective of what business that we work into, whether it's a salaried person or a job profession or a business person or any kind of an institution, we end up interacting with banking institutes, direct banks or non-banking institutes as well, for that matter, because the way of transaction is the currency, whether it is domestically or internationally. We would want to be transacting in currencies. There's an exchange of currencies, and therefore a mediator is something where the banks and the banking industry as such plays a very vital role in facilitating that whole process. Now, being a custodian of the money of so many customers, it becomes very imperative for these institutes to be following certain protocols and following certain rules in terms of making sure that the money is safe and the customers are also feeling safe in terms of transacting with an organization. Correct. So that gave birth to different kind of work or different kind of analysis in the banking industry to make sure that things are running fine, things are running smooth and all. To augment or rather to reinforce this whole belief of doing analysis and making sure that uh, the financial health of an institution is at par with what is expected, we had the great financial crisis of 2008, the subprime lending crisis, which we all have seen unfold in the last decade, where there's a lot of exposures with banks had in certain kind of uh, retail exposure, especially in the real estate kind of an area, where uh, it had a cascading effect once the repayments or the default started happening, or in terms of the repayments of the mortgages or the loans or the credit lines that the banking industry had extended over a period of time. And it had a very large impact across the globe, because by that time there was a lot of exposure, not just in one geography but across multiple geographies. These banks had invested heavily across different markets, so it had a lot of cascading impact in terms of the economies taking a toll across the globe. Right? And obviously that further enhance the importance of making sure that the risks are being known, declared, mitigated, and there's a foolproof mechanism to be having as a fail-safe back or a backup plan in terms of anything going wrong. And that's where the credit risk becomes a very important topic for all these institutes. That is where they would like to be spending time and effort in terms of making sure that things are in place. That's a broad background, therefore, about what is credit risk there. We'll be obviously throughout the session talking more about it as well. Correct. So let's begin with the whole process of risk management there. So we'll try to understand why risk modeling is important and what all are the steps typically an organization would take, and therefore how does SAS come into the picture in terms of helping them or making the process smoother for organizations, the vastness of the whole work, and where SAS helps them in coming to terms with the huge, humongous calculations and reporting and compliances and everything. Correct. Now again, just an instruction there before we get into any further details. We have a chat panel available, as you all can see in the Zoom meeting. Any questions there, if at all, while the session is on, please do not hesitate. Please drop in your questions or suggestions or whatever it is that you have to say into the chat, and we'll try to respond to it as earliest as possible, or we might just want to be holding them back depending on the topic of interest or topic of discussion, and come back to those questions in the session at an appropriate time, or if required, we might want to be responding it separately, privately in the chat as well. So depending on what you have written in the chat panel, the response would differ. If sometimes the time is a constraint, we might want to be parking those questions. We might come back to you later on as well. We all have your registration details, so depending on who has asked the question, it'll be easier for us to also respond back to the queries as well, if we are not able to cover up all of those things in the session today at least. Correct. So yeah, so that was one small instruction which I forgot sharing earlier on. Wonderful. So let's talk about risk management first per se, and then we will move ahead. So what is a risk management? Yeah, so that's one of those very important questions that we would want to be looking at first. And for that, let's look at risk management, how it is defined. So at SAS, we might want to be defining risk management as identification and evaluation, and therefore like we already have, okay, Q&A panel. All right. Yeah, we'll be coming to certain questions as and when time comes there. Correct. So the whole usage of resources in terms of money, in terms of the economical conditions, in terms of the capital that we have and everything. So identifying, evaluating, and therefore optimizing the resources for maximizing the profits given the risk that we are having is the whole process of risk management. So that is how it can be officially defined as a topic there. Now, when we talk about risk management, obviously every business would like to know the uncertainty. The future is always uncertain, and therefore you would surely want to be knowing in terms of what are the possible risks that we are having, and therefore the process begins at identifying the possible risks. We'll come to those details. Then we would have to be assessing those risks. So obviously in this whole process you'll have to be coming up with matrices to quantify that so that we can assess the risk, because it cannot be just judgmental saying that no, I feel it is too risky to be doing something like that. No, that doesn't really work always, or rather in a larger organizational setup that really doesn't happen. Yeah, so we'll have to be having matrices in terms of assessment of the risk, and therefore then moving on to the logical thing, how do we make sure that we have some controls, checks and balances there, and obviously keep on reviewing those controls, because the world is very dynamic, or the entire business operations everywhere are dynamic. Things keep on evolving, things keep on changing, new ways of transactions come in, new ways of products, line of credits will come up, and therefore the exposures and the risks will keep on evolving over a period of time. So obviously a review mechanism is very important, and it's a very ongoing process. You do not really have an end to it. Yeah, so once you have a review of your ongoing business scenarios, you would want to then redefine your uh, risks, or identify your risks, and then you would want to again go through that whole process of the assessment, identifying the matrices, how do we control them, and what can be the checks and balances, and then the review. So that's a pretty ongoing process that we would be having in a given scenario. All right, now what are the typical sources of risk? So the starting point, obviously identification of the risk there. Sorry. Yeah, so what could be the possible sources of the risk? There are multiples of them, obviously. Starting with the very first one in terms of, because banks generally on a larger scale, if you're talking about, operate across geographies, correct? So there could be a risk of losing money because of changes in the interest rates within the domestic market itself, or the foreign exchange rates also could be fluctuating, and which we all know that the currency market keeps on fluctuating uh, depending on the volatility of the businesses across different countries. Sometimes there's spikes in the currency rates as well, and you would have the risk of a sudden change, and therefore you would have to be having, or rather you would have to be prepared for addressing that particular kind of a risk as well. Correct. You would probably have a product that you might have invested heavily, and you've taken a heavy exposure to a particular investment there. As a bank, obviously, lending money is my primary, uh, let's say, work area, correct? And then we would also be earning, or rather money based on our investments, so that we can have our lending done. So we have deposits on which we have to pay interest. We are investing, we are earning money, and therefore there's a lot of uh, drivers which affect the whole business model, because there's no stable interest rate, there's no stable exchange rate, correct? And every country's economy fluctuates in a different pace, or not in an exact same way. Like you cannot be just saying that, okay, the US stocks are increasing and you'll have a cascading effect everywhere. Not doesn't anymore. correct? So your products might be invested, might start failing. There could be sometimes risks of certain legal judgments that can have our business to be paying certain penalties at times, or there could be certain decisions which go against our business, what you can say decisions that we have made, and therefore we lose money out there. There could be also very uh, what you can say catastrophic natural calamities at times, which can cause a huge and a sudden impact on the way the business operates. There are storms, there are earthquakes, there are like again we've just all experienced in the recent times the pandemic, which none of us were prepared for, correct? So that obviously adds up to the risk there. Yeah. So and again we always have the risk of our competition there doing better than us, and therefore trying to take up the opportunities and therefore take up the business, correct? So on multiple dimensions you are having risks being appearing around your business data or other business basically, correct? Now this is the broad way we would like to look at what are the possible general risks there. However, when we look at it from a business point of view, you can broadly classify them into something like a market risk, where interest rates, exchange rates, equity prices keep on fluctuating because those are market drivers there. All right. Sorry. Correct. You would then be looking at the credit risk, which is your borrowers or the people who have taken money from you, or your uh, who are obliged to pay back to you, start defaulting, and that is what we experienced in the subprime lending crisis there. Then you have liquidity risk, which is short-term cash needs. So funding problems are there. You're unable to trade or sell certain of your assets. You've probably anticipated a rise in the price of an asset and therefore made certain decisions based on future cash inflow, which probably isn't coming in the way that you are expecting, and therefore you're short of the cash. So liquidity crunch that we may want to call, or the working capital crunch as well there. So your short-term cash needs could be affected. So, and then there are the last but not the least, rather, the operational risks, which are like your internal failed processes or systems, certain problems within the way you are conducting your business, or it could be while conducting the business, there are some external risks as well in terms of, let's say, bank robbery or a theft or a natural calamity or a natural disaster there. So broadly, whatever we discussed in the previous slide could be classified into four broader kinds of risks there: market risk, a credit risk, a liquidity risk, and an operational risk. Our focus of the session obviously is about the credit risk because that's a larger thing where and that's pretty much one of the major lines of businesses of any banking institute or any financial institute there, of lending money and earning interest around the money that we have lent, and we collect the money back, and that's the main primary source of earning as well. That's the core business of banking. So therefore credit risk happens to be of utmost importance, not that the others aren't obviously, but that is where our focus of the session is going to be. So we will be talking about the credit risk part of it. All right. Now, as business already have a lot to think about for prepare for, they also have to be complying based to the regulations. So this is the risk part of it, and obviously because pretty much everybody is involved in this whole process of transactions, and citizens are at large, or the population at large is exposed to that risk directly, indirectly, because so when the bank is having some risk, I as an investor or I as a customer of the bank carry the burden of that risk also. And therefore to have some checks and balances, we always have regulators around the globe. Every country would have their own. There are certain common regulators across regions as well, and those regulations of their allow or other force us to be, or force the institutes to be making sure that certain things are in place. So we all, again, people working in this industry surely know about the Basel Accords, the Basel guidelines and all. So there are certain requirements to mitigate these risks. The regulatory authorities obviously have put some checks and balances. So certain guidelines are been given in terms of how much would be the capital, which again changes across the geographies and about depending on which is the immediate regulatory authority that you're reporting into, right? And they will enforce certain risk management. So apart from a proactive approach of me having to be mitigating the risk, I also have a regulatory compulsion for maintaining certain measures in the business operations so that I get a chance to be operating in the market. Otherwise, obviously, the licenses and everything are at stake, and heavy penalties can be enforced or levied upon for not being conforming to the regulations. Correct. Again, coming to the question certain, so the IFRS 9 is one of, again, the regulations there, which governs or rather which tells how typically, so basically IFRS stands here for International Financial Reporting System. It typically addresses the accounting or financial instruments and the monetary contracts between the parties. Okay, so the primary three topics where in IFRS are about classifications of your uh, classification of the financial instruments, how do you measure the risk there, and the financial assets, and how do you hedge, and so on and so forth. So there's specific accounting standard which the IFRS has given. Obviously, it's a guideline, it's not an enforcement as such, but again, uh, the country regulatory authorities decide upon whether it has to be complied upon, to what extent it has to be complied upon, and whether how strictly it has to be enforced and all. So we have seen a larger adoption of IFRS 9 across the region as well. I will talk about the region obviously primarily, apart from the US, UK, or the European markets. The Indian subcontinent or the Indian neighborhood countries and the APAC region also has been adopting these things. Correct. Then comes the IFRS 17 standards for the insurance contracts primarily. Correct, where the liabilities are calculated based on present value. So the guidelines obviously will tell you how do we account for, rather, because we don't want rather inflated books of the organization where everything starts looking very good and suddenly then we are not prepared for any last minute change or other catastrophes or sudden changes in the business. So the IFRS 17 standards would be telling us about how the present values are calculated, how should be the cash flows be looked into, or what should be the amount of provisions for the risk and everything. So the guidelines about 9 and 17, 9 primarily for the banking industry or the finance, and 17 for the insurance contract liabilities there. Again, for a bank, it would obviously be having insurance products and insurance investments as well. So both of those guidelines do apply to any banking institute as well. Correct. And then there are Solvency II directives in terms of the Union European law, which according to the Basel and all have been defined. And again, they're pretty similar to the Basel II norms, but then Solvency II norms typically has three major areas where they talk about. One is the requirement in terms of the capital, the amount of capital and the insurer should hold. The second set of requirements is about the governance and the risk management that has to be there and the supervision of the insurer. And the third pillar is about how much the disclosures and the transparency requirement, what all has to be compulsorily reported to the regulation on an ongoing process. So you cannot be really hiding certain numbers, everything has to be disclosed, or other whatever given by those guidelines has to be disclosed on a periodic basis, so that obviously there's a checks and balance both internally, because I am now more what you can say prudent in terms of knowing that okay, I have to be keeping a track of my business. Secondly, I know that somebody else is also going to be looking at, the regulatory authority is going to be looking at those numbers, and if not reported correctly there could be heavy penalties. So obviously all of these together make the organization obviously more alert in terms of its exposure or over exposures rather to certain kind of assets, certain kind of products, and likewise. And finally, there's a guidance and guidance and regulation around the model risk management. So the US guidance on model risk management, which is called as SR 11-7, uh, is basically to confirm again more of the appropriateness of the kind of models that are also implemented in terms of finding the defaults and finding the losses and everything. Yeah, so at every stage you have so again, just summarizing both of these slide decks that we have been looking at primarily. So let me just recap. So there are multiples of factors of risk, broadly categorized into market risk, credit risk, liquidity risk, and operational risk. And to make sure that there is enforcement of the organization to conform to all of these guidelines, we have regulatory bodies somewhere, sometimes in terms of just guidelines, sometimes in terms of enforcement, so as to make sure that the business is profitable as well as the money is safe, basically. The larger audience, which is the retail investors, or even for that matter, the commercial investors and all, their money happens to be safe and enough precaution is taken. People do not take decisions based on their own gut feelings and say that, okay, no, let's invest here. I know it'll work very fine and we'll get good returns, and suddenly something fails. Yeah, we pretty much do not want such kind of scenarios to happen, like the overexposure in case of the subprime crisis. One of the very great examples that we can cite every time, where just it was a big bubble that got just created, and that eventually hampered everybody. Yeah. Wonderful. Now, let us look at the risk management as a process, correct? Now, it doesn't really happen overnight. It's a very long and a lengthy process. We have to first, as an organization, commit to that process. So a bank would like to first be deciding itself that they, so certain commitments are compulsory, because then otherwise the operational licenses or other, they do not really get permission to be operating or transacting with other institutes. So as a company A, if I am wanting to transact with company B, if they are following those particular guidelines, it becomes convenient for me and easy for me to then do transactions with that company, because then I know that, okay, things are safe, or at least I can believe that things are working fine. I can take that amount of risk because of the organization conforming to those guidelines. However, as I said, once I commit myself as a force or as voluntary, whatever it may be, the compulsion to a process of risk management, I do not really just start it with day one. It's a lengthy process, and it's pretty much an ongoing process, as I said, because the modus operandis keep on changing. The historical data is increasing, so we get new insights about the historical data, and therefore like the kind of transactions have started changing. 20 years back, probably the kind of way we interacted with banks was different. But 2 decades hence, the kind of options that are available for us in terms of uh, pay by go, or let touch and pay, or whatever, or depending on the country that you belong to, you would have different ways of interacting for financial transactions there. Correct. New opportunities are there, new investment products come up, correct, and which come up with their own risks also, correct. So all those things are an ongoing process. So the most important starting, or the very important starting point for any risk management project, let's say, or a process, now, and this holds true with irrespective of risk management, any analytical process or any decision making process would always start with data management work, correct. So the first thing that the business would want to be doing is to make sure that it collects the data, because the data which is available is never in a very clean format and in a very homogeneous store. It is spread across different places, correct. I will have to be, as an organization, collect data from external sources also at times. And now the internal data might be easily accessible at least, but within the internal organization also, because there would be a lot of departments, because there would be a lot of products and classes, set of customers, the way the data is collected for different departments and different products. So would be different, correct? So let's say for a simple product like a credit card, because that's again a credit risk there, because I'm lending money in a way. Yeah, so there again, the way we collect the data for credit card and the tables that it gets saved into, the rate of interest there, the billing cycles there are far too different than probably for a home mortgage, would be different than for car loans or education loans, and likewise. So depending on the product, the kind of data which we store would be different, and therefore to collate all of that data, to have a homogeneous view would require a tremendous amount of data management capabilities, correct? And a lot of work basically goes into that. So the data typically can be just thought of as a dirty data, and in the raw form that it is collected, it is most often unusable data, at least from the point of view of the kind of analytical activities that we want to or we intend to do upon it. Yeah, so a lot of aggregation, joining, collation uh, needs to be done and then worked upon. Now, it is much more easier said than done. It can be a very humongous task of months and months of efforts into streamlining the data management activity also. Yeah, so there's a lot of data that needs to be wrangled from or rather pulled up from external sites and all, correct? So now there are products obviously which will help them help an organization. SAS has its own capabilities of data management, and typically it forms the foundation for the next process, which is the model development process. And that's where something that we call it as the analytical base tables is what gets as an output of the data management process. Correct. So what we intend to typically do in terms of the data management is finally prepare the data in terms of its consumption, at least from a calculations which are required for a credit score modeling or a credit scorecard preparation or a credit model or a probability default model or loss given model kind of a thing. So all of those data preparations is where the analytical base table generation has to be there. And each kind of model would require its own separate type of data preparation. So it's again a very humongous task in itself. So the tool has, the SAS tool obviously has its own capability of data management. We might not be obviously given the time that we have at hand, just about 3.5 hours to 4 hours. We'll not obviously be able to go through each and every activity. But yeah, a lot of data cleansing, data quality rules have to be applied before the data is standardized and then consumable for the model development. All right, now the model development process is again the crucial part of the crux of the process of risk management. One of the major activities, obviously, that is where the what you can call it as the we call it as the assessment statistics come into picture. So all the evaluation, typically the probability calculations and everything, all of that happens in the model development area. Now that obviously it can depend on the country or depend on the industry and the needs. The different types of models will be executed or employed. Certain of them are compulsory in terms of compulsory in the sense are guided by the regulatory bodies in terms of saying that you have to be maintaining these certain models. The remaining one are very proactively done by an organization as a fail-safe mechanism in terms of, let's say, to be more proactive than what the regulations are suggesting, so that any fluctuations, we are still within the range of the regulatory limits. Correct. So the businesses would deploy the models typically. That is a very next logical stage. So we will end up building again. This is a ongoing process of model development for a very logical reason about the changes in the patterns of data in terms of the behavior of customers and the profiles and the demographics being changing. For example, let's say a very simple thing, the earnings, if you just simply take as an example, probably just to quote as an hypothetical example, $1,000 income probably 10 years back would have been something and $1,000 income in today's world 20 years later or 10 years later would be meaning something different, because obviously the inflations, the price hikes, and the pay increases and everything, the growth in the economy would obviously lead to the earnings being increased, correct? Also probably the nature of spends, the nature of products has changed obviously, so new models would have to be there, new variables will keep on coming in, correct? Probably the age factor, let's say 10 20 years, or let's say 20 years back, the people opting for products like a credit card was where, let's say until I was, let's say 25 30, um, depending on which country you belong to, obviously you can just think of your own country and the demographics there, because currently in the session, as you can see, we have audience across multiple countries as well, correct? So it will be very hard for me to quote any specific country, but just you can think of your own country at least, and just think the change in the demographics of your own country. Now, for developed countries, the pace of change could be slightly slower. For developing countries, the rate of change of demographics and the habits and everything is a bit more faster. They're aspirational people. So within India, I myself can just probably cite certain examples in terms of, let's say, 20 years back or 15 years back at least, people using credit cards and other products of lending and all would typically want to be waiting till the age of 28, 29, 30 before they might want to be going, or let's say sometimes even 30 plus, correct, before they might want to be opting for a usage of a credit card like a product, correct. However, given the economy, given the state of economy right now that we are having, and the availability of these products, and the ease of access of these products also, correct, has made it much more easier for me to consume these products. So 18-year-old now has a credit card, or 20 years old has a credit card, and they are pretty much using it very easily and without much of hesitance, correct? So the demographics and the consumption patterns has changed. Now obviously the model earlier where we were consuming, where we probably had the age bucket only starting from 25 onwards, let's say, of a customer profile, now suddenly has changed to something 15 plus, 16 plus, and also having an exposure already without much of an income as a collateral there or a backing there, correct? So that model development obviously will again keep on reiterating itself, and it's an infinite loop basically, as you can pretty much logically think of. Now once the models are developed, the process actually, so this process though is a very heavy mathematically statistically driven process, um, the utility of these models is not, or the value that an organization derives of these models is not seen until they are deployed, correct? And that's where the model deployment, that is putting the model to use on a new data or on a larger data rather, because the model development may at times happen on samples of data, correct? Not happen sometime, but mostly it is done on samples of data, correct? So therefore, the development or the deployment basically would involve putting it to use on a larger data. Now, prior to using that on that data, you would want to be doubly sure about how its performance would be. So typically the deployment of model would involve processes of scenario analysis, where I would like to expose my model to different scenarios in the future and see whether it performs well. It would also involve me in terms of stress testing, in terms of exposing it to populations and the data of not only about size but variety as well, in terms of different demographics and what you might expect. So stress testing basically the models before we start consuming those. Yeah, so in scenario analysis basically it's changing a certain factor. Let's say for example, we're thinking of changing what the impact of interest rate change or recovery rate change, or let's say how a change affects the value of a portfolio, uh, given the change in capital or given these changes in interest rates and all. We would like to be doing that scenario analysis there. The stress testing goes a bit further there. What it does, it will test the outcome of these multiple factors or worst case scenarios basically. Now both stress testing along with scenario analysis eventually will help my organization determine whether whatever capital levels that we have thought of based on the modeling and based on the analysis, are they robust enough for having those extreme scenarios, or other are they enough to be supporting extreme events of risks also? Correct. And that is where that testing has been a very important process of this whole risk management plan or life cycle, you may want to call it as. Now again, there are guidelines to do that as well, and again the organizations try to be more strict with those guidelines internally before they even uh, find, or other, before even they submit those results even to the regulatory authorities. Internally they would want to be more strict with their models in terms of testing for extreme events. All right. And obviously the end part of it, of any process for that matter, uh, so it is always said that you cannot improve any process unless you have measured something. Yeah. So for example, even in an individual case, or if you have to improve yourself, or if you have to be improving your own, let's say, performance of whether it is playing a sport or doing some activity or whatever it may be, unless you measure something and monitor something as an incremental change, you'll not be able to improve a certain thing. Just a sec. Excuse me. So this whole process without the last stage is redundant, in the sense unless I keep on monitoring this whole process through different kind of reports and all, I will not be knowing whether I'm doing something correct or whether I'm heading in the right direction or not. Just a sec. Correct. So the tool again allows us to build. Now, again, I'm not talking about SAS as such right now. I'm just the general process that we're talking about. We'll also be looking uh, at what level SAS allows us to be looking into all of this. So at every stages, obviously, we have a SAS product supporting us in terms of facilitating the whole process in a very faster way, in a seamless way, making the end user's life much more convenient, rather than having to write a lot of lengthy codes and getting lost in the complexities of those codes and all. Presenting consumable user interfaces, consumable in the sense very intuitive user interfaces for the end user to be working with the large data. And then certain standard reports already coming out of the box, certain of those then can be developed on the fly at a site level or a customer level, depending on his own other assessments of the data. So monitoring of those models, monitoring of those performance of the models, which needs to be done on a very ongoing basis, so as to know where the model has started failing, and early warning signals then can be received through this reporting and monitoring activity, thereby allowing us to go back to the model, make sure that we have the appropriate changes being done, and then move ahead. All right, just a sec. Sorry. Wonderful. So moving to the next, let us look at the topic there, the credit risk part of it. All right, so here again, we'll just slightly dive into the credit risk modeling part of it and try to understand smaller details and nitty-gritties there. All right, so we are doing modeling here, and many activities go into the whole process of modeling, and the attempts are to address different business problems. Correct? It's not just one small area of work there. Correct? And therefore the amount of data, the kind of demographical information, or the size and variety of data will change depending on the problems there. All right. So for example, the risk modeling area of work could also be starting with a modeling for decisions like uh, at an application level itself of a mortgage or a credit card application. We would like to be making a decision using a mathematical model, obviously. And it's a very old as in it's been there for a long time now that organizations are resorting to, instead of judgmental calls, more statistical models, stats driven decision making. or data-driven decision making, so that the process is repetitive and it's not a person-dependent thing. The judgmental analysis, which we usually call it as the non-statistical analysis, basically, which goes through um, the gut feeling of the investor or the gut feeling of the evaluator, and not individually, possibly as an entity or a group of people, let's say a board of directors talking about a large-scale product or an infrastructure project and investments in that and all. Those still are at times evaluated one step beyond the statistical modeling also. So even after having a outcome of a mathematical model, you would still want to be contemplating based on your gut feelings or judgments whether a decision has to be made in terms of investments or not, or lending or not, in terms of, let's say, turnkey projects and all. So let's say there's a there's a big infrastructure project which has been there, and let's say there's a dam, let's say example, there's a dam to be built, and obviously the construction industry or the constructing company would want to be having money from a banking industry or a banking company, correct? Now as a bank, I would want to be lending money to that, thinking that okay, it's a very big infra project and all. Now there the kind of exposure that I'm getting into, or the risk I'm getting into, how much ever I would have historical data points, because those would be very few in numbers, because let's say the number of dams that are being built would not be as many as number of credit cards. Obviously, it will never be something that can be compared, correct? So the amount of data available in terms of the project would be very limited. It need not always be the case again that I always build a bridge or a dam and then I have a similar kind of a dam already there and tens of theirs for which at least the data is there, because each of those projects would be of a different time span at a different time in the economical state of the country. And so there, along with these mathematical models and other numbers that we come, the judgmental analysis, which is the official word usually used for non-statistical analysis, comes into the picture, where the stakeholders would eventually want to sit on those numbers and contemplate and then decide or then make a decision in terms of the risks and the decision in terms of yes or no kind of a thing. But on a broader basis, on a B2C kind of an scenario, the application scoring or application decisioning is one of the primary areas of support, where these models help organizations in terms of deciding onboarding of a customer for a credit line of product, for example. And then all of us probably have either been a part of that whole experience, where you go to a website of a company or a bank and a credit card company, let's say, and you apply for a credit card, and then you get a approval or a rejection at that point itself after you fill out a form, correct? So that's like an application scoring process basically. Then you could also have a loan monitoring process, or sometimes it's about only renewals. Then there could be ongoing credit lines for which you have to do modeling in terms of the collection on a regular basis, and then decide what is the action that you would want to be taking there. For example, let's say I have a house, a mortgage, and I have been repaying the mortgage on a monthly basis for the last few years. It might so happen that my personal demographical factors would change. My age increases, my job changes, my salary changes, my marital status changes, and therefore, at a certain point, I start to find a pinch in terms of repaying my mortgages, and that reflects in obviously certain of the data points which the bank will keep on collecting over a period of time. Now that's where then the risk should be flagged. Early warning should be given to the person, saying that okay, so and so profiles are appearing to be now prone to defaults, and you would want to be taking a corrective action already, right? So that's the another area of work. So at different stages of the credit product, you would need different kind of models. So right from an onboarding process to a process or a continued product to a product which has probably already moved into a default or like off and a write off kind of a thing, and so on and so forth. So the kind of activities that can typically go into is the credit assessment, the behavioral scoring, creating early warning default models, like what I have mentioned earlier, saying that okay, I should get early signs saying that okay, a specific profile is tending towards a default so that I can then initiate, let's say, a simple reminder call for that matter, or let's say an awareness call saying that, okay, you are a valued customer with us and these are the options of payment. Failing to do so, these are the different kind of action that as an institute we are legally bound to be taking on you. So that acts like a deterrence for avoiding the payment, and I'll probably as a customer be more alert in terms of saying that, oh, let me not miss my payment, let me try and see where I can squeeze some money from or cut short on my cost and expenses and make sure that the repayment is done. Yeah, that's like a ultimate end use of a model, correct? Saying that a customer who was about to default, but my early intervention in that whole process allowed me to uh, get that money back on a timely basis, correct? Avoiding that risk of losing out that cash flow, correct? So that's an early warning system there. Again, provisioning and loss forecasting. There would be certain percentage of customers we expect to default, certain profiles to default. And that's again where the probability of default models help us identify what is the chance of the default. Now, if it's a very high chance of a default, then we would want to be provisioning for the defaults already and make the loss reserving done there. Correct. So again, these are at the different stages where throughout the credit life cycle, different kind of modeling work will go into, and it will eventually lead into some actionables. All right. So broadly talking about, it's basically so in general, when we talk about the term credit risk, what we are referring to is, sorry, just a sec. Am I audible there? Quick check. All right. Anyways, yeah. So coming back to this particular thing, so generally the term credit risk would refer to, if we just have to be defining it, the possibility of a loss resulting from a person or a business not paying back their loan. Simple as that, correct? So the risk is primarily that of the lender, and it includes the loss of principal, the loss of interest, the possible disruption, therefore, of my business cash flows, the cost of collection because, and the delinquent loans, basically cost of collection of something which is not being paid for. Yeah. So just imagine, I am expecting an inflow of some X amount of dollars every month because of the amount of money that I have lent through. Any default would make sure that my cash flow gets disrupted, first of all. Secondly, now I'll have to spend extra on calling that person, sending emails or reminding them, or whatever XYZ action or a legal action, if at all it has to be taken, spending on those legal charges and all. So those are extra costs which eat up into my profits. So we have to be provisioning for that. And unless I have a portion for that cost, I will be at a loss, like, as a business. But how can I apportion? Only if I already anticipate certain amount of loss already. I anticipate that I will have to take so many legal cases. I anticipate that I'll have to make so many calls. I will anticipate I will have to send so many reminders or person to remind a customer. So if I already know those probabilities, I would be able to apportion that amount of cost, and that will be already taken care of in my cash flows. And obviously, therefore, the running of the business becomes a bit more smoother, correct? All right. The loss from loans, again, either could be complete or partial. Again, we'd like to be knowing that as well. So how much to be apportioning or how much to be keeping the cash flow for and lieu of the default needs to be known upfront, correct? So the regulatory authorities also would like to be knowing all of that information, how much money is with the bank as a safeguard for any kind of these losses incurred by the customers or do not pay on time. And therefore, again, multiple reasons for me to be doing all of this analysis at the back end, correct? I cannot be just saying that, okay, I've given you money, let me just sit back, wait for the interest to come back, and then enjoy the benefits. Obviously, when we are talking about millions of customers or lakhs of customers, let's say, I cannot be taking that amount of risk there. Wonderful. Now, when we are talking about this, obviously, there are certain statistics or numbers or the key parameters that we may want to call it as, which the institutes use in terms of quantifying certain risks and quantifying the exposures, quantifying the probabilities of defaults and other things. So let us look at those key parameters first of all. And we generally would be doing, not we in the session at least, but generally the organizations get into doing modeling and doing analysis for all of these key parameters there. So a very popular one, obviously starting off with, is the probability of the default model. Basically, it's all about the likelihood that a loan will not be repaid and therefore it falls into a default. So that's the probability of default, correct? So that's something that needs to be calculated, and we popularly known as the PD models, correct? So the default models and all. Then we have the other thing, which is the exposure at default, correct? The what is the exposure at default? It is basically the monetary value terms as an organization I'm exposed to, and to a person whom I'm lended money and which might be at risk. So if something goes bad, what is the volume of it going bad, or what is the monetary value terms of that going bad, basically. So that's the exposure at default. If defaulted, this is how much I'm exposed to as a risk, basically. Correct. Then there's a recovery rate for a given kind of an credit line. I would probably be already knowing through historical data or through empirical evidence is there. The amount of fraction of the value that I can possibly recover, either because of certain agreements that I have saying that, okay, in case of a loss, let's say for a organization, when the money has been lent, correct, and it goes into bankruptcy, or let's say it calls for a bankruptcy, there are obviously accounting practices, accounting standards in terms of the sequence in which the money has to be repaid. Yeah, so the shareholders is the last one where the money comes to. So after the solvency or of the sell off of an organization, how much money should be paid and whom should be paid first, and all those guidelines and rules are enforced. And therefore, I might already know when I'm exposing myself to a credit line that, okay, worst case scenario, this much is something that I can recover from, either because of that or because of the collateral that I have along with it. And let's say it's a distressed houses. Let's say what happened also in case of the subprime crisis. Let's say my house is there as a retail customer, correct? So I have a house mortgage, and obviously that acts like a collateral there. And let's say if I default and I call for a bankruptcy, and the bank is then going to be selling it as a distressed property, correct? Now, the value of the house when it is sold as a distressed property wouldn't be the value at which it was evaluated and basis on which the credit was extended, correct? So it will be far lesser. Again, depends on the economic conditions around. Either it could be very little or it could be marginally low or whatever. Sometimes it could be just recovering pretty much everything, and likewise. So that is a very variable thing, and that is all that goes into defining or rather identifying the recovery rates. Right? So the recovery rate basically is the fraction of the value that can be recovered as expected by the bank or the organization there, correct? And then comes the loss given default. Yeah. Now, what is loss given default? It's basically given the default is happening, this is the loss. Basically, the estimated loss if the obligator or if the person who I'm lended to goes into a default. So exposure is basically how much I am exposed myself to. It could be, let's say, $1 million is my exposure, but I know that I can recover some bit of it. So minus that recovery. So therefore, if you see the loss given default formulae, or the way it is computed, is what is my exposure and minus the recovery rate that I can have. So 10% of that can be recovered, or 20% of that can be recovered, or whatever it may be. So of the exposure, how much ever I can recover minus that remaining is the final loss, given that the default happens. Correct. The value of 1 for a basically means that the entire money is lost. And then finally, you would be computing something called as the expected loss. Basically, it's the summation of all the possible losses over a period of 12 months. Generally, again, the time frame could be changing, and there could be multiple windows of time frame that the numbers are computed for: 3 months, 6 months, 9 months, 12-month kind of a thing, so that we have a rolling number and we have enough time then to mitigate or to course correct the business operations and avoid larger losses there. So just an example here, just to show how these numbers come across. Correct. So in this scenario, let's say a company owes $1 million to the bank, which includes also, let's say, the principal and the interest. Now the bank is assuming a recovery rate of, let's say, 80%. That's what is mentioned here. And also it is assuming a 10% of probability of default. So first of all, I already know that the chance of default are lesser. And if at all I'm able to recover, I'll be able to recover not 100%, but only 80% of it. Correct. So how much is the expected loss and how it is computed, let's say. So first I will be computing something called as loss given default. And loss given default is computed as exposure at default minus how much I could recover. So 1 minus recovery rate basically. So that's the loss that I have. So in this particular scenario, it's pretty much like $1 million and I've recovered 80% of it. So 80 or other $800,000 is something that I recover. So $200,000 is something that I have as a loss given default, but the chances of default are only 10%. So 10% of that comes up to $20,000. So expected loss is this. Now this goes into the bookkeeping and the ledgers and all in terms of adjusting for the cash flows and all. And that is where the IFRS guidelines would come into picture, or the Basel III norms and Solvency II and everything. All of those guidelines would come into picture in terms of telling how this is to be accounted for, at what rate it is to be accounted. Out of these, what all numbers are to be reported and everything. Right. Again, the investments and the assets of the bank again should also be then accounted for the risks that they carry upon. Correct. So again, different kind of functions of the probability of default, the loss given default, and exposure at default, everything are then applied on that, and then the values are being reported. Right. So let's say as a bank, I have invested in an asset. Let's say it could be a building, it could be a land, it could be an investment, it could be anything. But again, it would also carry its own risks. It would also carry its own chances of failures, and therefore I'll have to be apportioning them or take into consideration all of that as well. And again, this is all mentioned in those guidelines in terms of how does it have to be reported, so that we do not live in a world of presumption saying that no, we have a lot of money. Let's say even if things go wrong, I know that I have X amount of assets, but when the risk happens and the assets also are exposed to that same risk, suddenly you are in a fix where I'm not able to cater to all the money or other cater to my customer in terms of their deposits and everything. So therefore, not only to the customers taking money from you, the risks applies to also on the assets that you have invested in, and therefore equally important for us to be making sure that the risks are taken into consideration, and therefore all of these functions mathematically are applied to even the assets side of the business as well, and then taken into consideration so that risks on either side is being taken care of. All right, now we will talk about an example hereafter about the credit products, obviously. And at this point, we would obviously be wanting to look at something called as the commonly used thing called as the scorecards. So especially in a case of application, risk evaluation or application credit risk evaluation, scorecards play a very important role and a very crucial role, and allow them to become much more consumable and therefore, rather, let's say, easy to implement kind of a thing. All right, so having looked at the different types of risks that the businesses face and the regulatory standards, let's look at the scorecards as well. All right, so this is how a scorecard gets defined. So there are two words here, as you can see. First is the credit scoring, and then is the credit scorecard. Correct. Now, this is one of the very crucial activities of the whole process of credit risk management from the point of view of model building and other processes aligned around it, which is about building scorecards and getting scores. So let's look at these two words. So credit scoring is defined as a statistical model that assigns a risk value to a prospective customer or a prospective credit account or an existing credit account. Correct. So it's basically allowing me to rank a credit application and therefore help me classify all the borrowers into either good customers or bad customers, which is like not bad, but then saying that, okay, they might fail in terms of repayments or they are more likely to be defaulting. All right, so the model is basically obviously built, any mathematical model, any statistical model usually goes based on or is built based on historical data. Correct. So in the past, whatever applications that we would have, we would already know uh, whom we had lended to, and within that, who has defaulted, who has not defaulted. So that acts like my source data, and that acts like my starting point of the analysis, where as a data management, I'll have to make sure that through my data warehouses databases, I skim through all that data about how many applications were there. Amongst that, how many did we give money to or give lending to, and within that, how much whoever defaulted, who did not default. Now, while doing so, again, as we will talk in a short while, in part of the data management process, it is very important for us to also define the window of the data. So there's a process of filtering and defining the time snapshot of the data when it comes to this analytical base table building. Correct. So we'll be talking about that as well. Because we cannot just be saying that, okay, let us take the entire data from the inception. That would be like too humongous and also probably not really relevant also, because things have changed over a period of time. All right. Now, having built those models based on the historical data, I would get a score ranking as well. But then from a consumption point of view, from an application scoring process, a scorecard becomes much more easy for us to consume. Correct. So what does a scorecard do? Basically, it takes the information which the model has built and it puts it into a format which can be easily consumable. It's much more interpretable, first of all, obviously, and consumable also. Consumable in the sense, to take an action in terms of the deployment of a model becomes much more convenient. All right. So looking at this, talking about this, the reasons to use scorecards or the reasons why organizations go for credit scorecards basically is easy to use and understand. It's expected again by the regulatory agency. That's again one more reason. And it's very easy to implement and therefore monitor as well. Now let's look at an example here so that we understand how does the scorecard look like and the utility of the scorecard. Correct. So for example, let's say in a scorecard, first of all, let me just talk about certain nomenclatures or taxonomies there. There are two major words that will keep on occurring in terms of when we talk about the scorecard. One is a characteristic and the other is an attribute. And then what comes out is a point system. So characteristic is kind of a variable in a data set or um, uh, a demographic information it could be, or any other information that we collect of a customer. The attribute would be a certain value of that characteristic at which you would like to have a threshold or a cutoff value kind of a thing. Cutoff in the sense, or define the boundaries for excuse me just a second. So for example, here, if you look at the characteristic is, let's say it's a new applicant that we're looking at. I would ask the applicant his age, his income, and whether he has a house or not, and if it's his own house or it's a rented apartment or a rented house. Correct. Now, for ease of consumption, and rather to give an example how a scorecard is easy to consume, what as a scorecard building process would be to identifying these cutoff points, saying let age be less than 25. So let age buckets be between less than 25, 25 to 33, 33 to 45, and 45 above. Now, the process of that model building and scorecard building would involve identifying these cutoff points. Why 25? Why not 26? Or why 33? Why not 35? Why 45 and not 50? And likewise. So that process of scorecard building will be where all these numbers come from. But this is like the end usage of a scorecard there. And then we have points being associated. Now, again, this is a very similar thing when we apply for certain visas for certain countries also. You have a scorecarding mechanism. So it's not only applicable as a scorecard development for banking industry. There could be larger, what you can say, utilities of scorecard building as well, apart from just the banking industry. So while we are talking about credit risk, which typically involves in terms of the banking industry, let's look at this. So let's say a person having an age less than 25 gets 100 points, age between 25 to 33 gets 120 points, and age, so 100, 120, 185, 200. Those are the points that we have allocated for the different ages. Now, whenever a new applicant is there, we just simply look at his age. Now, in this case, the age is 32, which belongs to the second bucket, and therefore 120 points is what he gets first. From a house point of view, because he owns a house and he's not staying in a rented apartment or a rented house, he gets those additional 225 points. And then when we look at his salary or her salary, again, not to be gender specific or gender biased, he or her, he's earning or she's earning $30,000 there. And that falls into the income bucket, which is again the third bucket in this case. So the buckets for income, or the groups or the bins for income, are less than 10,000, 10,000 to 25, 25 to 35, 35 to 50, and 50 above. Now, carefully observe here the fact that those binnings that we are having are not equi-spaced bins. Yeah, the first bin is of 0 to 10,000. Then again, it's a bucket of 15,000 gap, or a range of 15,000. So 10 to 25. Then there's again only 10,000 bucket and 25 to 35. And then a larger bucket of again 15,000, which is 35 to 50. And then 50 above. It could be 50 above anything basically. So that could be a range which is a very, very, very large range also. Correct. So they need not be equi-spaced, and they never are equi-spaced. It's an overstatement, but yeah, because never you cannot say. But and then there's a very logical reason also for that, because generally, and once we see the scorecard, how it is built, rather, we'll see that when we observe the distribution of a particular characteristic there across the variable of interest or the information of interest, which is defaults or no defaults, you would typically see that there's never a monotonic relationship. Like I always see a linear pattern, or I always see a specific pattern into it. It could be a changing. For example, the way a customer of age less than 25 behaves would be different. The way a customer between the age 25 to 33 behaves when it's not literally behaves, but in terms of their consumption of the product, in terms of how I use my credit card, correct, will be far too different. After 33, typically, you might expect a customer to be a bit more settled in his career, also in his life, and therefore he'd be more careful, possibly, in terms of how he would like to consume his credits and all, and therefore he'll be more cautious about it, and that reflects in the points that he's being allocated there. Same goes with income also. Less than 25, probably I'm more vulnerable. More than 35, I'm very comfortable. Probably 25 to 35 might be a range where I'm just a borderline comfortable, or borderline kind of a vulnerable kind of a person, or profile rather, not a person personally, but a profile. correct? Because again, the more I have income, the more disposable income I'll have, the more my risk-taking ability increases, and the more I consume risk products or credit products, because I have a confidence of repaying back. So that transactions or my customer profile would reflect in the way I transact with an organization, and therefore the point systems or the points will also reflect the same thing, the credit worthiness in a way, or not literally the credit worthiness, but the probability of default of that bucket will translate into higher or lower points. So generally, if the chances of defaults are more of a specific age bucket or income bucket or whatever, the scores or the points allocated are lesser. Correct. Now the cumulative points for this particular customer comes up to be a value of, let's say, 525, which is like 120 plus 225 plus 180. Now, the organization, which is the bank or NBFC or the non-banking financial organization also, might then decide whatever is the cutoff based on their own capability of taking risks and uh, the capital that they have at hand or the exposures that they have anticipated and all. They might decide that, okay, 500 might be a cutoff for lending, correct? Again, just taking it as a reference point or thumb rule, saying that, let's say 500 is a cutoff, saying that anybody whose score goes beyond 500 could be extended credit. Otherwise, you will say decline, your application has been rejected, kind of a thing. Fine. So that is how these point systems would work. And therefore, in this particular scenario, I might be wanting to have this customer accepted for credit, and I'll probably either could be lending or giving him a credit card or a mortgage or whatever it is the product that he is being interested in. Now, this is the end utility of this whole model, correct? So as I said, these scorecards could be built for different purposes and at different stages of the whole life cycle of the customer in terms of the product consumption, right from the onboarding stage, which is what we is popularly known as the application scorecards. So there are different scorecards that can be built. It could be either an application scorecard, it could be a behavioral scorecard, or a collection scorecard, or early warning scorecard, and likewise. So an application scorecard basically is to determine whether to accept a new customer or not. So it's basically at the very first starting point, an onboarding kind of a process. Right. So whether the current profile of the customer is worth enough to be extended a loan or a credit line. The behavioral scorecard, on the other hand, will be about an existing account with the organization. So I already know that, okay, I have already lent money or credit, and now I am on a very ongoing basis updating his score. For example, like we have credit scores. Generally, these are also scorecards, correct? The number as such, again, depending on credit bureaus and different countries, you will have different numbers and different things, correct? So there are some popular organizations which are third-party ones which keep on doing credit scoring, and they keep on sharing that numbers of credit score uh, to the clients and to the evaluators as well. For example, let's say I'm a bank and I want to lend you money. I will want to take a credit score from a company like an Equifax or XYZ in your organization, in your country. And then based on that, I would also want to be having my own evaluation in place as well. So I'll not just 100% trust that, but that starts, or that helps me in as a starting point, at least in terms of identifying should I be giving money or not. So, but again, as we all know, every few months or every few days, depending on the regulatory rules or guidelines of that country and the industry, the score keeps on getting updated. Yeah. So when I took my first credit card, probably I had a score which was different, and thereafter it started changing as and when my credit utilization increased, as and when I started repaying on time, or the moment I start defaulting, my credit score starts going down. Or the more I take my exposure as a retail customer, also the credit score starts going down based on the income and so on and so forth, correct? So that's a pretty ongoing process which needs to be there, so that what it allows me therefore to do is early warning systems eventually, correct? And then there are some collection scorecards. Basically, these will help us estimate the willingness to pay and the ability to pay uh, post an account getting into a delinquency, correct? So once I have already decided a loan to be bad, let's say, or it has already gone bad, all right, I think there is a question there, and I'm pretty much already answering that thing to a larger extent. But anyways, uh, sorry, I was just looking at the Q&A panel there, and correct. So yeah, I was talking about the collection scorecard. So that's specific to loans gone bad kind of a thing, and within that again, I would like to be deciding the actions to be taken, saying at what level has the loan gone bad, correct? What is the exposure? How much is the value? What is the profile of the customer who has taken that money? Uh, how do we evaluate his possibility of a repayment? And within that, again, we'll rank them so as to at least decide in the resource utilization, because I'll have to have my collection team, my legal team working on those cases, and to prioritize around that in terms of, and then again creating an if then else rule saying that if the score of a collection scorecard is so and so lesser, we might want to put little efforts uh, in terms of pushing it for recovery. If the score is higher, then we might want to be spending a lot of time. Probably it might eventually get into a written off kind of a case. Correct. Now, then again, as I said, early warning scorecards are also there, which basically, so early warning scorecards are basically like what I have been saying is basically to keep on a very ongoing basis, see how the scores are changing for a customer. So, and those eventually act like my trigger points basically. So let's say for a consecutive 6-7 months or a couple of years that I'm into that mortgage of a house, I am having a score. Let's say, let's assume for the sake of an example, we are having a score between, let's say, 100 to 1000, where 700 is a good number, let's say some number. Okay, we'll not get into that details of what are the good and bad thing, but let's say 700 is a good number. For consecutive couple of years, I'm always having a score above 700, but then suddenly for whatever reasons, the score got dropped from 700 to, let's say, 650 and to 625 and to 600 in consecutive runs of the scorecards. Now, this will act as a trigger point for the bank or the institute saying that, okay, customer so and so has dropped his score, and please look into it kind of thing. So then they'll put me onto watch list ideally, and they would want to be monitor. They would want to get me into a discussion, probably saying that, okay, so and so is happening. We found that your score has dropped. Uh, could you just tell me the reasons? Probably it could be a job loss, it could be XYZ, it could be any other reason also, or it could be the thing that I'm probably overexposed suddenly. I have probably taken another loan somewhere and that has caused the score to drop. And then the bank might want to be negotiating further in terms of, let's say, no, we'll probably have to be increasing your rate, or the vice versa also. If the score is very high, you are in a, as a customer, the retail customer would be in a position to then say that, okay, I would like to have my rate of interest reduced, because as you can see, again, a scenario where obviously as a customer, I might not want to be having access to that score, internal scores there. But generally those openly available scores also can be used as a reference point by a retail customer saying that, okay, if I can see my score improving, I might want to be really going to the bank and renegotiating my interest rates also. But anyways, correct. And then we have the fraud detection scorecards also. Basically, it allows us to rank order the accounts or applications according to the probability that the account might be fraudulent, and thus alerts you for potential fraudulent activity. Now, this is where I think based on one of the questions also that I can think of for. So there are two parallel activities which keep on happening in an organization, correct? One which is about the credit risk analysis that we are trying to look into, and the other one which you also especially from a fraud point of view, which is the money laundering activities. Now, generally what is seen in an organization, there would be separate people working on the data. The fraud team usually looks at the data from a different perspective. The credit risk team would be looking at the data from a different perspective, correct? Though the underlying factual data remains the same, the rules that are applied of scenarios, the triggering rules are different for the fraud team and a credit team, correct? And therefore, this is one of those scorecards which can help the AML team eventually to have trigger certain alerts in terms of saying that, oh, okay, this because probably, let's say, just to give an example of this particular scenario, I could have been a customer with the bank. I have a savings or a current account or a checking account with a bank as well, and I also have a mortgage, correct? Now the risk team would be looking at one aspect of it earlier, but then about the exposure, about the demographic profile and other things. However, on a saving account, the transaction which I have been making are such that I am, let's say, withdrawing fast money. Let's say every alternate day I'm withdrawing some cash from my account, or there are huge sudden deposits in my account. Now, these are generally money laundering rules alerts, correct? Which trigger an alert saying that, okay, there is some suspicious activity happening in the saving account and all. Now, because I am the same person, and because I also have a mortgage and I also have a saving account, just because these are two different products doesn't mean that they have to be worked upon in isolation. And therefore, the fraud scorecards allow me to have one quick view for the credit line of business into the transactions also, saying that, okay, there has been an alert there, probably that should be something that needs to be known to the credit team also. And therefore, the scorecard is one way to identify that, and the scorecard is one way to reflect that, okay, there's some fraudulent activities happening around in that account as well, which therefore should increase my risk for the credit product also. Yeah, so just because of the suspicious activities in my saving account, my credit card account also gets a flag and my score there drops, so that the risk increases and therefore prompts for an action in terms of more micromanagement of that account, or more micro, or let's say declining of certain transactions, or let's say validation of certain transactions more often than earlier. Let's say generally, I don't know, in certain countries that we have seen that, okay, at a point of sale also, certain transactions need to be authorized by the bank, where after verification, only the transaction goes ahead, correct? Now, this is a system not in place in each country, but in some of those countries, at least I have seen that, let's say you are at a superstore and you are at the point of sale at the checkout, you're using your card, and suddenly there's a pop-up on the machine saying that please authorize, contact the bank right now. So you have to make a call, or the store, from the store you make a call to the bank, you verify your details, and whatever the customer executive there on the call would ask you for certain information, you validate that, and only then the transaction goes ahead, correct? And yeah, so this is where the integration, or rather the sharing of information, can happen between these particular two lines of areas of work, rather, let's say, like the fraud team, which is the anti-money laundering team, and the credit risk team to be working. So it's like a passing of information kind of a thing. Also, when the anti-money laundering team is, again, though it's not a topic of the day right now, but generally also when the anti-money laundering team works on a specific alert, the risk information always is populated there also, or is presented on the screen, saying that, okay, so and so customer currently, uh, because his saving account transactions have been alerted, he also has so and so risk associated in terms of the other products that we are having here, correct? So there's a two-way communication, both the information, because eventually we cannot be looking at each product in isolation. They have to be looked into as a toto, and that's where that, again, this is just to answer and a very logical question, therefore I just thought of answering that as well. in terms of the fact that fraud detection card helping anti-money laundering. Yeah, I hope that's answered there. Yeah, so, yep. Just a sec, something in the chat panel. Wonderful. Yeah, so let's move ahead about from the scoring. Now, let's look at the process now. So this is more conceptual thing that we were discussing. Let's look into slightly more minor details or micro details. Let's say not micro, but more details into the development workflow. So what are the steps generally? So risk modeling, development work, correct? So the process is a very straightforward process. Extract the data, correct? Select the variables of interest, and then scorecard development, back testing, model deployment, and then monitoring. Something that we saw earlier also, but it's presented in a different format there. Now, why it is important to look at these points again is just to see now from a SAS point of view how these are important and how things will span out, correct? Uh, where which tool comes into the picture and so on and so forth. So when we talk about the data extraction, first of all, so these are the different steps or other, let's say, the tool that we would want to be using. So there are multiple ways things are being done, correct? So I have some data prep which can be done outside SAS also, correct? I could be doing the data prep in SAS, but through coding as well, or through programming as well, or through a ETL product that we have. But eventually, prior to sending the data into the modeling part of it, I would want to be working on with a tool which is the SAS risk modeling. The version obviously would keep on getting updated as the time progresses, but then the risk modeling of which I will be showing you UI of how does it look like and all. So the data extraction part happens in a tool known as the SAS risk modeling. And the output of that whole process, as I said earlier also, is the analytical base tables. Yeah. So that's the analytical task, is basically to get the data ready. Now, here again, when we say that, what is happening is basically the process is generally about ETL. So getting the tables from variety of sources. Some of my tables could be in Oracle, some of them could be in Excel format, some of them could be flat files and all. Some of the data is already in SAS dataset format. So the whole process of collating, joining, filtering, because I could have different products. I might be working only for a specific product in that case. So filtering the data, filtering based on time also. So let's say only last 1 year data or last 2 years data could be there. So applying certain data cleansing rules. So all of that goes into the data extraction part of it, correct? And finally, what, as I said earlier, would be the end result would be the analytical based tables out there. Then comes the next stage. Yeah, so this is just a snapshot of the work there, which is about, just a sec. Yeah, so within the data preparation, again, this is just a snapshot of that product, how it looks like. And I think there's some pop-up on the screen. Yeah. So data preparation project has to be created. So within the risk modeling tool, we would be looking at uh, this kind of a project where, again, you define a project. For the project, then we define certain parameters, target population, different variables, what all variables need to be there, and finally the output data, which is the ABT. Right. Then comes the next stage, which is, okay, so within that again, let me just go to a bit of details of that whole process of the data building. Just a sec. Yeah, so when we are defining the project, there are certain pre-configured, or we call them as out of the box projects there. So depending on what kind of analytical model that you're building, whether you're building it for probability of default or loss given default or credit conversion factor CCF, and so on and so forth, the project has to be changed, because then the kind of columns that are required as an underlying thing will be different. Correct. And that's the reason these things are to be built as part of this process. Then there are certain parameters here. So what are the kind of parameters? So the raw data which is there sometimes is too granular in nature. So you would have to then define what level of aggregation you would want to be working with. Correct. And you would then want to be defining the date part of it. You will have to be defining the filters, and if there are certain variables which are shared across other projects also, those have to be defined. And then the target gets defined. Basically, when we say target population, the records on which you want to perform your analysis. So which line of business and so on and so forth. So that filtration happens there. Then the variables, sometimes certain calculations also be done. Yeah, so sometimes aggregated variables are there. Some of them are only just count variables and so on and so forth. So the variable then has to be defined in terms of its usage, its aggregation, its context, and so on and so forth. And then lastly, your analytical base table gets generated. Yeah. Then comes the most important part, which is the main part, rather, say the modeling part of it, which is about variable selection and scorecard development. Okay. These are two steps in a sequential way, generally done. Correct. Now, these activities will happen in a different application, but within the same platform of SAS called as the Model Studio. And for that, we'll be using something called as an add-on, which is called as the risk modeling add-on for SAS visual machine learning. Correct. So the UI of the tool is that of Model Studio, but within that, we'll get an add-on which allows us to have some more buttons and some more nodes rather. Some of you probably have seen Enterprise Miner as a tool earlier. So we had a similar add-on in Enterprise Miner also for credit scoring. And the newer product, then equivalent product for Enterprise Miner in the VIA world is that of SAS Model Studio. So on the similar line, we have an add-on for risk modeling as well. So the demo would involve getting into Model Studio and seeing how the pipeline looks like and all. Correct. So within that, again, as you can see here, so for variable selection, primarily we'll look at something called as interactive grouping node, because again, we like to see, like earlier when we saw characteristic age, income, and home. Now, were those the only few characters available? No. So there were many other characteristics also. However, why did we choose them? And that's where the variable selection comes into the picture, saying that, okay, because we found that, okay, the proportions of defaults and non-defaults could be well explained by these few characteristics only. So that is like the variable selection part of the whole process there. Correct. So interactive binning or interactive grouping rather. In sometimes it's also called as interactive binning. So alternatively, it is being called by that name. So that node will allow us to have the variable selection being done for us. Correct. And then we have a scorecard development for which then there are two nodes. One is a scorecard node and a very interesting node called as the reject inference node as well. So once we go to the node, we'll discuss more about that reject inference also. But as the name suggests, basically, generally what we say is that the model building process happens on the historical data. Correct. Now, it's very true, not generally, it's pretty much always that any statistical model building process will happen on an historical data. However, when we are doing this model building process of defaults, we are only considering the people who are our own customers. For example, let's say 1,000 customers applied for a loan or a credit card, of which let's say only 400 were given credit cards. These 400 people will then start generating data for us, and they will leave their footprints in the form of transactions, defaults, no defaults, and likewise. That becomes our source of information, saying that out of these 400 or 4,000 or 4 million or whatever it may be, X proportion, or let's say 20% have defaulted, or 10% have defaulted, or only 5% have defaulted. The remaining have been paying it on time, correct? Generally, the rate of defaults wouldn't be very high, because then otherwise it will be very difficult for banks or any of the organizations to sustain in the market for a longer time, correct? So anyways, so point is, the historical data is only of those people for which we have accepted the application first of all. Now, there are so many other people also for whom we have rejected the application, meaning out of a million customer or out of 1,000 customers, 600 applications we actually didn't even entertain. We didn't say that, we didn't even lend them, or we didn't offer them a credit card or a loan or whatever. So they were rejected people. Now, why it is important step is because when I'm going to be putting my model to use eventually, it is it needs to be having the real representation of the actual data, saying that okay, amongst so and so applications, the real proportion or the prior probabilities kind of a thing of acceptance itself was so and so, and the rejection was so and so. And that is where an external data called as the rejects data, that these were the profiles that we had rejected, needs to be brought into and get exposed to the model so that it adapts itself and to the rejections also, and thereby the scoring process is altered. So this is how the typical workflow would look like. So first starting point, grouping the characteristic variables into attributes. Again, now this is further going into more details of all of these points. Yeah. So this is from a tool perspective. These are the three nodes that will get utilized. That is interactive grouping, scorecard node, and reject inference. Correct. However, when we look at the smaller processes in between, essentially what we are trying to do is the characteristics, that is the variables. Generally, we call them as in statistical modeling, or we don't call them as attributes here, at least, because the meaning of the word attribute, especially in this context, is a slightly different. Therefore, I'm avoiding the word attribute. Otherwise, it can be also sometimes called as an attribute in a general modeling terminology. But here, yeah, so from the characteristics, we calculate or we do variable selection based on the weight of evidence calculations. Yeah, so it's basically an interactive binning, but there's a user interface where we can manipulate, or rather we can edit those binning. We do not go with just equally spaced binning there. And there's a specific reason, as we said earlier also, the characteristics or the behavior of that variable changes at different points of time. So let's say need not be equidistant. Like when we saw about income, the behavior of a customer which is earning 10,000 to 20,000 would be different. Certainly after 20,000 to 50,000, it could be similar. From 50 to 60, it could be different, and likewise. So they need not be equidistant always. And that's where the coarse binning as a word comes into picture, needs to be done. And unequal binning happens in that whole bin. So first, the software would try to do the binning on its own. And then as an analyst, it's my job then to intervene there, try to see if I can edit something. And also I have to keep in mind the practical aspect of deployment of the model. Not always the mathematical cutoffs will be something that I can be implemented. For example, the home value is a very commonly used example of this binning process. Let's say I am asking for a characteristic information of a customer, saying that if you own a house, what is the value of the house? It could be some X number of currency, dollars, reals, rupees, or ringgits, or whatever it may be, dirhams, so on and so forth. But some X amount of currency will be the value. Now, generally, um, let's assume that the house prices we quote in terms of thousands of dollars. Okay, 10,000, 20,000, 30,000, 40,000, and in the buckets of 10,000, generally the value of the house can be easily found out. It will be very hard for us to estimate a value of a house to the decimal place, or other even to the first units of the number. For example, to quote a value saying that my house price is 1,528,822 dollars. So to that precision, it would be very difficult to ascertain a price of a house. correct, in terms of an estimation. But rather to be broadly giving, my house is for $50,000, or my house is $1 million, or something like that, is much more easier to be implemented as a model. Now, when statistically the binning would happen, the binning boundaries may come up very um, precise numbers, which from a practical point of view may be very hard to implement or hard to work upon as a model development point of view or a decision making point of view. And that is where the analyst's role comes into editing those bins. And that's a pretty important part of the whole process. Then there's something called as an information value, which is computed in terms of telling that, okay, so and so variable allows us to interpret. So apart from weight of evidences, which acts like a numerical representation of a variable in a model, the information value allows me to judge how much of an important that variable is in terms of describing the defaults and non-defaults. Then generally the default scorecard uses a model which is the logistic regression, and that's the scaling of the points. However, the tool also has a lot of other models also. So we might have complex models like a decision tree. We might want to use some machine learning algorithms like a neural network, a support vector machine, a gradient boosting, a random forest. So there are multiple other models available within the tool, can be utilized also. But the default one is the logistic regression. Post that is what is the reject inference being performed to assign an outcome variable to the rejected applications. Correct? That's, as we said earlier, uh, to bring into the data which we didn't lend money to earlier, so that the model also gets exposed to the fact that, okay, out of so and so, so many were not ever entertained as customers only. Yeah, so then the process of augmenting the data that contains the accepted applicants and then the rejected applicants along with the outcome of the loan status. So one is we have rejected, and therefore it doesn't really matter whether they default or not, because they're already not our customers, so it's not a point of consideration that they will default. However, within the accepted, then we have a default. So the defaults or the defaults have to be considered then vis-a-vis the entire population also. And then again, getting into the grouping of characteristics, because now we have additional information, and then finally building a scorecard. So it's again within the whole small number of nodes, it is an iterative process in itself. Correct. Now, looking at the interactive grouping there, uh, sec. Yeah. So the interactive grouping would typically look like this, or rather, let's say the model studio as such, from a pipeline point of view, looks something like this on the screen, which I will, as I said, in the second half or in the last few hour or last 1 hour or so, we'll get into a demonstration where I will at least show you the tool, how it looks like, how what are the nitty-gritties of the tool, and how SAS is much more convenient for conducting those kind of work. Yeah, so we bring in a data. The interactive grouping node is something that comes into picture. Then comes the scorecard, then reject inference. Again, another set of interactive grouping, and then finally another scorecard building. So a general pipeline, as the nomenclature that we use, is something that looks like this in the product called a SAS Model Studio on the SAS Via platform. Correct. Again, an information which we'll discuss towards the end about what is the Via platform and all. For some people, probably were already aware of the Via platform. For others, within SAS, we have two flavors or two platforms: the SAS 9 platform and the SAS Via platform. SAS Via being the new platform, operational in the market since the last 7-8 years, let's say, so 2018 onwards, let's say 2017 onwards, that SAS has started offering the Via platform also to the clients, and more or less pretty much all of our products now are functional on the Via platform also, and rather they're more advanced in certain areas of work because they are developed directly on the Via platform itself. Correct. So that's the node, which is the interactive grouping. All right, this node is used for two primary works. To first eliminate certain characteristics or variables which are weak or uninformative, let's say. And within the important variables, create binning. Now, the advantage of binning is basically any kind of outlier impacts are not taken care of. So you don't have outliers creating biases in the analysis, which is a very typical problem in a linear kind of a model or a mathematical model, which is just an equation-based model. And using a continuous variable or a measurement scale variable into that kind of a model, uh, it gets badly impacted by any small number of outliers also. So by already grouping those factors, for example, let's say when you're looking at income of a person, correct? Now just imagine from the bank point of view, there will be customers with low income, medium income, high income, but the high income could be way high also. So somebody who's probably a CEO of a company would also be there in the list, where an employee of the same company or a junior employee, just a new intern of that company, would also be part of the database. Now this income of that person who's the CEO would be way too high than that of an intern, and that will be a skewed information from an income perspective, and that is where the analysis will be biased, or it will be what you can say, that specific CEO and or those high net income people who would be very little in number, but they will be so away from the mass people that they will skew the analysis towards themselves, and unnecessarily your generalization of the model becomes a problem then. Yeah, so that is the problem of extreme observation. So the grouping or the binning process rather, or interactive binning, is one process where it allows us to take care of outliers in a very convenient way without actually tweaking the data, because generally, mathematically speaking, a popular belief or a popular approach, rather not belief, a popular approach of handling outliers is one, the very easiest one is to just remove those outliers and treat them separately. Second is by applying some mathematical transformations and trying to curtail the particular data. Now, in case of mathematical transformations, again, when we are interpreting those numbers, it becomes much more a difficulty, because let's say a log of a value needs to be interpreted, or a square root of a value needs to be interpreted in the business context, or an exponential of a value needs to be interpreted in terms of a business context. So the usability of that information starts reducing, correct? Or creating actionables on that starts reducing, and that's where binning kind of a mechanism helps much more, because then you have ranges defined saying that, okay, anybody above this value take this decision, anybody between these two values take another decision, kind of a thing. So actionables become much more convenient because of that binning process basically. Yeah, so yeah, pretty much all of those points is what I intended to mention there. Correct. Now, what could be possible characteristics like mentioned? Characteristics are also known as variables. Could be like, let's say, age, or could be number of cards, could be the income, could be residence status. It could be time at the current address, very important, because how long I have been staying at a specific address provides information about stability in terms of geography, so that if required I need to be chased down, I know that, okay, this person stays here for a long number of years, and obviously therefore he will have acquaintances around in the neighborhood, so it will be easy for him to be tracked down if required. Yeah, so it's more of a trust building kind of information basically for us. So if I'm staying at a specific address since my childhood, and now the last 30-40 years I've been staying there, obviously the bank would be saying that, oh, okay, now I can trust him because then the neighborhood knows him, he's been there, his school is there, he wouldn't go away, correct? However, if I have been staying at an address for just last 6 months, and possibility is that I've even changing it quite often there. So because in certain cases, if you see applications where you are having a larger value of risk profile, or larger credit that you are demanding, or larger amount of credit that you are demanding, in certain countries we have seen that you not only provide the present address and the amount of time that you are staying at the present address, you also have to provide the information of the previous address and the amount of time that you were staying at the previous address also. So not only one address information, but multiple address informations at times are also took into consideration, and the tenure of stay also. correct? That gives us, or that gives the banks an information or an insight in terms of the vulnerability or the credit worthiness or the stability, or as I said, if required, is he a person where I can easily go and check for with his neighborhood or colleagues or whatever. Again, like in terms of income, apart from income, generally the information about how long you have been working with an organization is a very important information point, because then um, that income source is the basis of me giving money to you. And if that is a very recent one, and that becomes riskier for me, because then what is the guarantee that I get my money back, correct? So all these factors, therefore, now these are certain things which we understand from our own understanding of the data or our interaction with the people and whatever that we have been born and seeing around our world. However, it needs to be validated mathematically. I might perceive that a factor is important, however mathematically it might not just give me enough insights into the data, correct? So that is where all these mathematical modeling or statistical modeling comes into the picture. Yeah, so time at current job, inquiries in the past 3 months, very important. How desperate are you in terms of getting money, correct? Or how many credits are you being exposed to so and so far? Or how has been your payment performance? Have you been paying on time so far, or not? And likewise, so there could be n number of factors that could be tested first of all. Again, doesn't mean that again certain of these information points could be very crucial, so depending on different countries that you're belonging to. For example, age in certain countries is something that is not allowed to be used, because it's a very confidential information, it's a very personal information. So certain countries disallow the usage of age kind of variables in your models, correct? Yeah, just a sec. Just give me a second, sorry. All right, no more things in the chat. Sorry for that. Yeah, so let's move ahead. All right, now from the list of characteristics that we just saw, um, we could then think of certain variables to be as interval variables, which is like continuously measurement scale variables, or some of them could be nominal, ordinal, binary, and likewise. So basically, when we talk about interval, we're expecting infinite number of individual values like a or income, especially. It could be a very good example of an interval scale variable. And then with nominal, ordinal, or binary, we are expecting a finite number of unique values there, irrespective of whether it's a interval or nominal or whatever. You might want to be doing a grouping around that. So for nominal kind of variables, you might want to, let's say city is a variable which already is a nominal variable, but however you might have a lot of cities around, and you might have seen a similarity in the behavior of certain cities, so you might want to be grouping them together into lesser groups also, so that the behavior is easily captured. Yeah, so it could be then converted into, let's say, metros, non-metros, or tier 1, tier 2 cities, depending again on the geography that you're staying in, correct? So again, every country would have a different way of calling it. In India, we always call it as metros, and then tier 1, tier 2, tier 3 kind of a thing. But again, as I said, based on the country, based on the number of cities, based on the economic progress or the economic status of the country, these classes would be changing, correct? So again, just to bullet out the different individual steps within this whole process. So the initial characteristic analysis of an interval variable would involve certain steps. For example, first would be to pre-bin the interval variables into a number of user-specific buckets. Okay, then to aggregate into smaller number of groups, then calculate the assessment, or rather assess these smaller groups in terms of their count of defaults and non-defaults, and then finally get into overriding those generated groups into coarse binning. So this step involves something called as coarse binning. This is like finite binning. This is coarse binning, or finer binning, coarse binning. At this point, once the bins are generated, we calculate a numerical value, which is the weight of evidences, uh, which is a logged value of distribution of good divided by distribution of bad. And then you would have a number of values of weight of evidence coming is basically a strength of an variable's value, helping us in differentiating whether it's a good account or a bad account. Correct. So that's the whole idea of computing something called as a weight of evidence. So high negative values will typically correspond to higher risk, and higher positive values will typically correspond to lower risks, which is a very logical thing. All right, like I said earlier, also mentioned earlier, the post step of calculating weight of evidence is to calculate something called as an information value, which again is an indicator basically to tell us how, basically look at this. Yeah. The higher the value. So for variables, we calculate the information value as a whole rather than as individual bins. And the information value would then help us that lower the value, the less or the more redundant is the variable, the higher the value, more important or significant is the variable. So that's how typically the variables are then looked into. Alternate to the information value, we might also be wanting to use some statistics like a Gini statistic or a Gini's coefficient also. All right. Now, after looking at the interactive grouping, we would look at the scorecard building process also. Wonderful. So scorecard is something that we had stopped at. The scorecard development process, again, it's used twice within general pipeline there. And generally, so as I said, the default one is the logistic regression that gets utilized as a model for building the scorecard. So, however, there is a possibility of using any type of other model also, which is the machine learning model, which is supported in this tool. All right. Now, to start off with, what happens is the interactive grouping node will build weight of evidence and group variables, and the values of it look something like the number of inquiries variable here. So the variable, let's say, would be number of inquiries. Let's say how many times somebody has done an inquiry for a credit, kind of a thing. Now, the advantage again of the binning process is one part which we discussed about was the outliers earlier, where we said that the outliers impact on the analysis gets mitigated because of the binning. On the similar side, the impact of missing values is also mitigated because generally we know that the missing values, if at all there are any, the entire row is ignored for the analysis, correct? So in that scenario, uh, treating missingness into a single group itself allows us to avoid those loss of data points from the analysis, correct? So that way it is very helpful. So here again, the weight of evidence is calculated. One of the question was simply, not simply, sorry. One of the question was how do we calculate the distribution of good and bad? Simply after the binning, we count the defaults and the non-defaults in a specific bucket, and then gives me the proportion, and that is the basis of computing the weight of evidence. Simply, correct. Now, on this, basically, why is this not moving ahead? Yeah. This is how the scorecard typically would come up as a result here. All right, so the weight of evidences values are then used to as an input into predicting the target flag. Now here, if you see the inquiries which were there, which is for 0 inquiries. The weight of evidence is a high value. And if you see, which translates into a scorecard or a scorecard points, this is the highest points. So for missing value or 0 value or unknown value, because there are like 0 bad or 0 inquiries, and the weight of evidence was basically reflecting that there were very less defaulters out there, and that led to having a higher score point. Whereas the lowest score point is that of 12, 13, 14. We don't have the data out here right now. But if you see the value 3 also, the weight of evidence is a negative value, meaning the defaults were a bit high for inquiries with 3. 4 inquiries, the defaults were a bit more higher. 5 inquiries further more higher. 6 inquiries further more higher. So generally, it has been probably observed. If you see, the trend is the more the inquiries, the higher the chances of default, because then essentially you're getting rejected by multiples of lenders, and therefore you're trying desperately to go for multiple inquiries kind of a thing. Okay, so that could be a rationale behind the thought there. Anyways, the logistic regression typically looks something like this. Again, it's not a statistics class. We will not get into the details of this logistic regression equation. Any questions, you could just drop a message in the Q&A and I'll try to address that. But basically, it's a linear model trying to see the impact of different attributes, or here in this case, characteristics, in terms of the chances of making a default, where the P here is a probability of default given the input factors of age, income, and n number of other parameters. Now, age and income are just representative here right now. And there could be like hundreds of different variables available for us to use in this particular model. And then the logistic regression has its own methods of variable selection, like a forward method of selecting variables, a backward or a stepwise or a fast backward, and a full model fitted or a lasso kind of a mechanism there. Correct. Post which is where the scaling comes into the picture. All right. So after the variable selection within the regression happens, the scaling of the scorecard is basically the process where the scorecard's ranges of scores are defined. All right. So again, the simple reasons of that scaling is ease of interpretation. Sometimes it is legal requirement, because let's say I need to be knowing, let's say, why a particular application was rejected. I have the right to know why I was not given money, or I was not given a credit card, and likewise. So the score range at least then helps me to give out the information, but not the details as such. For example, because I will give a range saying that, okay, like every time, I don't know how many of probably have done, I'm sure many of you would have done that, but you check your own credit score, correct? And then generally in the report it will always say that, okay, if you want to increase your credit score, or these are the parameters which are important, and if there are so many inquiries, then the credit score goes up. If the credit utilization is so and so, then the score goes up. Or if you have so many number of credit cards, the score goes down. Or if you have so many late payments, the score goes down. So you generally get an idea, and then the ranges are given so that you understand your own self. So as a legal requirement, sometimes because the customers may demand saying that, can you please tell me why I was not given money, or why I was not given a credit card or a mortgage, or whatever it may be, correct? So sometimes it's a legal binding for disclosing that information. So rather than being exact, a range allows us to be much more specific. Say our general information can be revealed, and again, it's a very transparent, therefore, mechanism. All right. Now, generally, to perform the scaling, we have to make certain assumptions. So the first assumption is basically to assume that the ratio of good customers to bad customers in your data is to be there, and basically events to non-events, and that is basically the odds value. For example, suppose we have made an assumption that in my data there are 50 good customers for every bad customer, then the odds becomes 50:1. Then again, we must then decide the score that we want to associate for that odds value, correct? So let's say we define a range saying that my scorecard always has to be the lowest value will be 200 to highest value is 1000. Correct. So the lowest odds and the highest odds we'll try to take, and we'll give those values there. So for example, here we decided, okay, we want to give 300 as a score for the odds of 50:1. Like when we say 50:1, we're saying one bad customer per 50 good customers. And then, so that's like a worst scenario. The good scenario would be, let's say, slightly better scenario, one bad customer per 100 good customers. And likewise, and therefore, and then let's say it translates to a score of 280 for, let's say, one bad customer per 25 good customers. So once we decide a point of reference of, let's say, 50 odds, score is 300, 100 odds, let's say 320, and then the computation automatically starts happening for the other values of odds. And then the scaling point allocation happens using certain formulae, which is shown on the screen. Correct. Now, let's not get into that formulae part of it. And then, obviously, the system or the software or the algorithm, mechanism, method, the equation basically helps us get those values of scores for different bins or groups that have been generated in the data. So for every bucket, I know what is how many defaults and how many non-defaults are there. So I automatically calculate the odds, and that allows me to generate the scoring value. So that's a pretty simple mathematical activity. It's not a rocket science basically. Once I have defined what is the lower value and what is the higher value, the remaining calculations are much more easier. It's just a extrapolation there to be done. All right. Then once the scorecard is developed, the next logical step comes into the picture, which is the back testing of the whole model. And that again happens in the risk modeling software. So the first point, the data extraction was in SAS risk modeling. The variable selection and the scorecard development happened in Model Studio. And now from back testing onwards, we again go back to the risk modeling part of it. So backtesting, model deployment, and tracking and monitoring all happen out there. So this is how the tool would look like. So manage risk models is the option that we will see, and we'll have options of data preparation, model backtesting, model implementation, model monitoring, and so on and so forth available in that particular tool. Now the models either could be built in SAS, or sometimes you'll also be allowed to be, sometimes I think depending on the scenario that you have licenses and everything in place. Open source models could also be implemented sometime. Yeah, so you could have a Python model, you could have a SAS visual data mining, or it could be a code driven model. For example, there could be an older version of SAS like an enterprise miner. You have certain model developed, you would want to utilize that here, so it can be utilized there as well. So, or it could be a user defined set of rules also that you might have based on your judgments or based on some benchmarks that you have been following. So different types of models can exist there. And then in the back testing, basically it's all about validating the model on the historical data before the deployment happens in that. Is the performance good or bad? So are the rules which have come up apply onto the data and give me good results or not? So in the steps of back testing, you would typically be seeing selecting the best models to be implemented, then initiating the backtesting. Within the model, there could be a case that there are different versions. So you might have to select a version there of the same model. Like sometime what happens, like somebody mentioned earlier also, let's say certain parameters change. So over a 6-month period, you realize that, okay, one of the variable which needs to be included was not there in the previous model because of certain economic scenarios there. And now you'd want to add that information. So now a new model has been there, but broadly just one variable up and down. So therefore, it's just another version of the same model rather than a completely new model. Correct. So, or let's say because the data has changed, certain new factors have become significant, certain old factors have become insignificant. So that all thing could happen, and that would lead to different versions of the same model. Then we would want to then select the date range for the scoring purpose and then generate the results. The reports generally are presented in fashion of defining the health of the model and model monitoring reports are also generated based on the actual score. So for the backtesting, generally, you get to know the overall health of a model, and typically for scoring data and model monitoring reports, something looking off like this. So whether the health of the model is good or bad, any discrepancies or more discrepancies, the warning symbol is indicated, telling that, okay, no, 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 please look into this. So is the model stable? There are some stability indexes also reported, and some values like accuracy, the Guinness value, the ROC or the area under the curve values. So all of those required statistics are reported. And as you can see here, the model report or the model monitoring reports are implemented in a very sequential and a timely manner. So it could be a month on month or a quarter on quarter execution of these reports, leading to tell us, okay, how is the model performing? And therefore, generating some reports of this sort where allows us to see the model health across time. So let's say here from March 2012 to November to December to February, this is how the model's version has been performing in terms of the informations there. Correct. So then that way, and again, multiple models, so version 1, version 2, so that we know which one to retain, which one to update, which one to ignore, or is it time? So the moment we see the performance drop slightly, we might want to go back to the model, create a new version of the model so that the performance isn't degraded. Correct. So these kind of extra reporting work is something that the tool allows us to do seamlessly without much of an effort there. Correct. So that's the utility of having a solution from SAS for an organization. Now, is this completely a rocket science? The answer is no. Correct. So there are organizations probably who are not using SAS would probably want to be developing an in-house application for doing all of that work, obviously. However, it requires a lot of efforts, and it would be a very person specific or a team specific work that they should envisage or they should anticipate all of these kind of reports, and that leading that all these reports are being then generated. Whereas in a solution here, what the organization gets is tried and tested, implemented at multiple sites, analysis there. Though it's the same available in open source, but your efforts of redoing that or reinventing the wheel generally are saved. Correct. And that is the whole idea of having to go with a vendor like SAS in terms of a solution which is a very critical solution, where you don't want to take chances in terms of missing information or misrepresenting information and other things. Correct. So that's particular thing. Now we'll be moving on to the application, where I want to show you how the application is. But prior to that, let me give you a brief about the Via platform, just in case if some of you are completely new to this environment. So as I said, Via is a new platform from SAS. Again, when I say new, it is in comparative reasons or cases where vis-a-vis the SAS 9 platform, which has been there for a long time. This is a new platform since last 5-6 years that we're having. Now, this is a cloud-enabled platform with a runtime environment called as the Cloud Analytics Services Engine, which has the main unique feature or a different feature of in-memory processing, in-memory storage, and parallel processing of the data. And therefore, having the data stored in the RAM and parallel processing, the computation speed is tremendous. So it's a very high speed processing engine, and thereby doing all these complex mathematical calculations for computing different scores, weight of evidences, risk scores, scorecards, and all. This process is shortened in terms of the execution time. So rather than having to wait for few hours, or let's say half a day sometimes in case of execution of certain job flows, because the size of the data is tremendous. When a bank, like let's say a multi-country operating bank is there and it's looking at its portfolios of and customer bases, we are looking at millions of records, correct? And across different time spans or across few months of data, the amount of data that we need to be processing is humongous, correct? And even if the rules are simple, the execution time also is sometimes the calculations are very complex, the aggregations are to be done, and so on and so forth. So the engine, which is of parallel processing with an in-memory data store, allows us to execute those activities or jobs in a much more faster and smoother way, giving the results faster, and thereby obviously the decision making is much more faster or speeded up. Right, so that's the Via platform for us. Again, the data sources which Via can access is again multiples on-premise or in the cloud, the relational, unstructured, or flat files. Correct. So a wide variety of sources of data can be accessed by this particular application. Correct. Access of the data from the disk and the in-memory. Again, we'll not get into the understanding of cache libs and all. And then a common platform supporting different applications for different kind of work and for different kind of users in an organization. For example, the common logon screen for all of the applications on Via platform would be the SAS drive. Thereafter, there are programmers who might use an application of SAS Studio. There are reporting teams can use the visual analytics application for dashboard development. There are database administrators and data stewards and all using data studio, data quality, data explorer kind of applications for any kind of data preparation, ETL kind of works. There are data analysts or data scientists typically using the model studio and the model manager for model development. And on top of all of these, the other applications which are specific to solutions like the risk modeling solution, sitting on top of all of these other applications, consuming the same power of the cache server at the backend. Right? So having all of this across on the same platform, therefore allows us to have very little movement of the data, or rather near to no movement of the data. Once it is on the SAS environment, pretty much it's consumable by anybody and everybody with different needs of data, right from data management to model development to model deployment to monitoring the model, everything happening at one single platform. Unlike earlier within SAS family itself, we had to have multiple applications or client applications which would create files and share within amongst ourselves. So it was a very lengthy approach there. All right, so I'm accessing a virtual machine actually rather than an actual installation there. So that's the slight difference. So generally all of these applications on Via are web-based applications. So when we have to use them, we generally just open a browser. Correct. And I'm just going to be logging into the SAS drive, which is the first log on screen. As you can see, there are different shortcuts already given to me in the bookmarks, but I'll just go with the default first and log into the SAS drive. Okay. Now I have separate virtual machines as well so that I have certain different things to be displayed. All right. All right, so this is how a SAS drive looks like on two different images, which I have for different purposes, basically. Correct. One where I'm going to do the scorecarding work, and the other one where I have to just display you the risk modeling tool there. Correct. So generally, I would come here. Now, this is the entry point for the Via applications. The list of applications are all available on the left-hand side of the screen as an applications, and there are different applications that are available here. Correct. So right from data preparation, and this data preparation is slightly different than the risk modeling data preparation. This is like more a general purpose data preparation where different kind of transformations of ETL work can be done on the data. So let's say if I don't want to, I'm building models which are not risk related models, but general purpose statistical models. And I want to prepare my data. I would typically come to this data studio, get into the different transformations, as you can see here, and then get my work done and get my data prepared. Now, all of these things, but especially in relation to the risk data preparation, are there in the data preparation step of risk modeling. However, the look and feel is slightly different. There are some more metadata points out there, and that is why the screen is or an application is different. This is more of a general purpose ETL product. Correct. Then you have data visualization and the reports which are there, which are also generated using Explore and Visualize. So the tool that will come into handy here is this. So we come to manage risk models, and thereafter, as you can see here, something that we did mention earlier, or something that was shown. So these are the correct. So data preparation, back testing, model implementation, model monitoring, all of those things are available out here. Okay. Now I have something chat. Is it possible to upload our data into SAS via? I tried earlier, but I could not do it. Okay. You can upload your data into SAS via, but I'm not sure which environment you are using. So I'll not be able to answer your question right now. You could be more specific. Where were you accessing SAS via? And then probably I'll be able to help more. If it's on SAS via for learner, then there's a different way to do it. In on-premise SAS via, there's a different way to do it. So the answer will depend on the installation or the access to the via that you have had in terms of uploading your own data into the SAS via, right? So yeah. Anyways, so first of all, let me come here in the data preparation stage. If you recollect me talking about this particular thing, okay, so this is where I had, sorry, I didn't realize I closed this PowerPoint. I wanted to show you certain things back there again before. Yeah, so I'll keep this particular screen up and so that I can have. So let's say when we saw earlier, the process started with data extraction. And we said that in the data extraction, this is how the screen would look like. And now I would like to finally show it to you. So this is the data preparation project, correct? So that's the data preparation project that we have, correct? And ideally, you can see here, there's an option of new project and there's a lot of details to be filled in. Now, one of the important details apart from the name and other thing is the purpose of this project. What is the purpose that you're preparing your data? Now, look at this. I have to define here itself that, okay, am I building the data so that I can eventually build a probability of default models, or am I preparing the data so that I can do a loss given default modeling work, and likewise. So because the requirement of data pre-processing will change, the details will change, the aggregation levels will change, and so on and so forth. And therefore, this is very important. I'm right now not going to be getting into anything of this. And do you want to have a filter applied before the data is selected, or do you want to have an access to the direct input or whatever? So you can choose that as well. Correct. And then there would be a subgroup that will be there. So within, let's say, probability of default, will it be for retail applications? Will it for customers? Will it be for corporate applications or corporate customers, and so on and so forth? So this allows us to apply filters automatically while picking up the data and all. Now, having all of done this, so on and so forth, a project would get generated, and a project would be something like this, where all that information is uploaded. So look at this. So this is a probability of default project with retail financial accounts. This is already being completed. So let us just double click so that I can see and explain you what all things are captured. So first of all, the set physical set name, basically the table. As you can see, the extension of that table is called as ABT, analytical base table. We are not able to edit the physical name in the project. And what does it talk about? It's like basically when you build the data set, it is created and stored with this name. The physical name of the data must be unique across, cannot exceed blah, blah, blah. And those rules are there. The aggregation is something that allows me to decide whether I'm doing a monthly aggregation of the data or a quarterly or yearly, or at what time stamp or time zone, or let's say time interval rather, to be more precise, the aggregation of the data will happen. And then this will decide how the filters are applied on the data, and summations or aggregations in terms of average or sum would be happening. The period to be displayed, so 6 months would be the outcome period there, and so on and so forth. Then in the target population right now, there are no filters and other things applied. So there is neither a exclusion filter nor an inclusion filter, but then we have a list of variables that are to be brought in and what are the kind of aggregations and other things. Correct. So a lot of information just for making sure that the data gets prepared properly. So again, what are input variables, what variables are output variables, everything gets defined out here. And finally, the build data set comes into the picture. Yeah, this is where you would execute this particular task as well, correct? Now, if you want this process to be a repeated process, you would then deploy this as a job, and the job will then be a scheduled job, correct? So there will be a job viewer which will allow me to see it and then schedule those jobs at a specific interval of time. Now, once this data is being prepared, typically you would want to go into model building process. Correct? We've seen these three things also. So the model building process happens in a different application. The application name for that is Model Studio. So instead of going through the risks, I would rather go into build models. Now, when we were into the data preparation, we created a project that was a data preparation project. Here, a model building process is another separate kind of a project that gets created. So here as well, we will have to be creating a different project. All right. So let's say I'll create this as a new project and I'll call it as a demo scorecard. All right. What kind of a project it is? Let it be a data mining and machine learning project. Correct. And we are not going to be looking at any template as of now, but a template is basically a set of nodes already put into for us so that we save time on building it. So there are some predefined templates. Look at this. Advanced template for risk modeling is already there. We will be seeing that as well in a while, but basic template for risk modeling is there. And yeah, there are two templates for risk modeling. So to start off with, let us go to a blank template so that we understand what is that template thing. I'll select a data. The data is available for me already. Something called as accepts that I'll try to use. So there are some 27 columns and some 3000 rows. Not a very great size of data, but it's pretty decent data. I will just try to increase this size so that we get to see what these columns are all about, correct? Yeah, so look at this. I'm only looking at the label column so that we understand about the data. It's number of children, number in household, basically how many people are there, age, time and address, time at job, telephone, number of my bank loans that have been taken. So this bank is called as my bank, let's say. Number of finished loans, income, some EC card holder, salary plus EC card, and then some status. Now then some external risk information like the credit bureaus and all, which are third party people who always maintain some information. So that information along with my other demographic information, location of that bureau also, and number of running loans, region. Sometimes the region plays a very important role because there are some blacklisted regions also where the risks of defaults automatically just because of the address goes very high. Whether it's a large region or not, or requested for cache, and so on and so forth. As you can see, these are the different kind of variables. And finally, the most important one is the good bad variable, which allows me to tell whether the default was there or not. So if you see the actual data points, this is how the table would look like. And when I explain the last column, the good bad is given in a binary form, correct? So I take up this data. Now, because I'm building a model, general practice in modeling is that we divide the data into training data and the validation data as well. So let me just get into that as well. The default partitioning of the data, I will not change, but it's 60, 30, 10. So 60% data is training data, 30% is validation data, and another 10% goes into testing. That's the kind of data partitioning I would like to do, and that saves me. All right, I'm just waiting for this to open. I'm very sorry for that. I don't know, it's taking the internet speed probably is some concern there. Okay, finally. I don't know why it's been a long time. Wonderful. So as you can see here, one of the very important messages, it says that you must assign a variable with the role of target in order to run the pipeline. Now, obviously, my interest is going to be about a good loan or a bad loan. So let me just search for that variable, which is good, bad. What was it? Where is it? Sorry, not this one. Yeah, good, bad. Yeah, so GB, this is the good, bad variable. And this variable has to be made the target variable. Only then it will be able to function well. Okay, why is it? Yeah. So this is a role which I'll set it up as a target variable. Correct. And so if I see the target levels, basically the automatic thing that the system takes up is event as one. So the defaults have been identified as ones and the non-defaults have been identified as zero. That's how the data gets processed. So we came from, so assume that the accepts data was something that got prepared in the data preparation screen out here. Correct. So this is where the data got prepared. Yeah, right now this is a sample which is created with 50% zeros and 50% ones. It's a balanced sample, purposely created that way so that the model starts learning the data well. Correct. And having the target defined, now I can go to the pipeline part of it. In the pipeline, I will bring in the important node for us right now is the interactive grouping. And for that, let us look where do we find it. So there are nodes which are available here, and these nodes are segregated into data mining, pre-processing, data supervised learning, uh, post-processing, and some miscellaneous. So let me expand this as well. Correct. So as you can see here, a couple of things that are important for us, and they come with a special this thing. What we call it as a license. Correct. So those are the interactive grouping. This comes with a special license of risk modeling. You then have the reject inference node here. Correct. So these are the two nodes which come with the default license here. Post that, if you scroll down also, these are the kind of different models that we can build on top of it. So right from simpler ones like logistic to complex ones like neural network or SVM and so on and so forth. Further, if we come down, this is the node that again we are going to be looking at into the called as a scorecard. All right. Like we mentioned, there are some open source models you might want to be implementing, and that's where the open source code. Now, this is not from an implementation point of view, but this is more from a evaluation point of view. There's another place where we actually put open source model for implementation. But yeah, we are this tool supports having uh, open source models also. Now, anyways, what we are going to do is we're going to be first a bit of delay in response to this virtual machine, I think. So let's anyway. So I'm going to be doing the interactive grouping first of all on top of this node. So I drag and drop it here. Correct. Now, if you see the node interactive grouping, first of all, here if I hover over the mouse, I get the node details, what it means. So it tells me what this node does basically. It says that, okay, the interactive grouping node is a data mining process, pre-processing node that performs initial variable screening and groups variable values into classes that can be used for input variable for predictive modeling, and so on and so forth. The weight of evidence measure is calculated to assess the predictive power of each attribute, and the information value and the Gini statistic are calculated, and so on and so forth. Again, very important, it provides an interactive grouping editor that enables you to manually group variables also. So that's one important information. Along with that, you also get to the help center, which takes you to the appropriate documentation for this particular node. Again, very important, this node is not a standard default node available in Model Studio. It only comes with a licensed product, and that is what is that warning symbol mentioned here. The documentation of the version software that is not covered by the standard support, blah, blah, blah. And you will get to see typically all that details out there. Now, how do I go back? Correct. So this is the help center. Let me close this help center. Okay, when I go to the interactive grouping, as you can see, there are different properties. So predefined groupings, we want to import grouping data. So let's say if for whatever reason your business has already been following certain groups and you would like to just use them, we might want to have that particular thing. correct? Apart from that, then you have interval variable binning options. So there are different methods of binning, quantile and bucketing. How many number of bins and special code options and likewise. So again, we are not getting into details of each of those particular, what you can say, the properties out here. That's not the objective here. But the sign is that there's a lot of options that allow me to play around with the way these groups are being generated, what are the criteria of this thing, and so on and so forth. Correct. So quite a lot of properties which will define how the groups are being generated. Fair enough. Now, for the timing, I'll just run this node so as to just show you what that grouping does basically and how the results are being generated. Just a few more minutes before we conclude the session. So a couple of more things that I can show it to you. Now this node is running. As you can see, this icon indicates that a task is being generated or executed at the back end. Quickly, the interactive grouping will also start running. All right, I will have to just check the log, what has happened here. It's difficult, there's nothing in the log. Anyways, I'll try to figure out what has gone wrong there, something. But post this is where you have the scorecard node generally that would execute. I'll just show you the node and how it is, the properties which are there. So one of the option here is analysis variable weight of evidences or predefined groups. And this is the scaling options that are there for the odds that we discussed here. So as you can see here for odds 50, what are the scorecard points that you want to do, and points to double the odds. So for 100, it will be for every doubling or other every 50, 50, 50, then the points will be increasing by 20, 20, or let's say every doubling the odds basically. Correct. So that is how the scorecard will generate, and then you'll get as an output there. They said the default for that is logistic regression here is the model which is available for us to consume. Correct. Now, once the scorecard is built, you would want to then come back here and then a back testing of the model will happen. Currently, no models are available, so a model has to be defined. So a model specification will happen where either we have a new user defined scorecard there, or we might go to adding a model and picking up a project from an existing project. So like we have created a project earlier, let's say, from there, we might want to pick up a project. Now this is already pre-created, so I'm just using it right now. And I'll just say add the model. Right, so that's the model that I have added. Oh, okay. Anyways, so that data adding and everything has to be done. Okay, and finally, once you have the back testing being done, you would want to get into the model implementation and the model monitoring. This is the place, because right now there are no models, but this is the place where, like I showed to you, you will get to see the charts of model monitoring, which is something of this sort. Yeah, so these kind of reports will come into, so model health and model monitoring reports. Correct. So there's a lot of pre-work to be done there. So you're not able to see those models right now, and it's a pretty lengthy demonstration as well. But this is how the application would typically look like in terms of model development out here, and model implementation, backtesting, and data preparation, which is called as the SAS risk modeling tool. Correct. All right, so that brings us to the end of the session out here. It's already 12 o'clock here in the Indian Standard Time. So thank you all so much for attending. I hope it was a session that was informative, and it was great to have all of you in this session for so long. And thank you once again from my side here. Let me just quickly say goodbye to all of you.